more insight here from one of our favorites, Kathryn Rooney Vera, head of global macro and chief investment strategist over at Bloomberg Capital Markets. Kathryn, always great to have you. Always great to get your insights.
Thank you.
We're at a time right now where I think everyone's trying to figure out here, are we sort of setting up for another leg of this bull market, or should we all sort of be, ducking under the covers because of inflation and supply chain issues and all the other drama going on around there? Do you have confidence right now in, I guess, some of the price action that we've been seeing in the market?
I have confidence, Romaine, in that the Fed's going to continue to run policy hot and let inflation run for the foreseeable future. So in that sense, yes, risk on, stay long risk assets, keep searching for yield, look at emerging markets for the next 6 to 10 months, Romaine, I would say. I mean, the Fed gave us a pretty clear time frame in terms of when they think inflation, or specifically Jay Powell did in his press conference, specifically when he expects inflation to start to decelerate. He said 2Q, 3Q. The risk here, of course, is that inflation either accelerates beyond their measure of control, or that the market loses confidence in the Fed's ability to tackle inflation. I think both are real risks. Inflation is being allowed to run very hot, bringing with it its own systemic risks and its own inherent risks to economic growth.
Gold has been catching a bid as we worry more about inflation. Are you hedging out the inflation risk in any way, Kathryn?
Absolutely. We have been for the past year. Actually, we at Baltic a year ago said that inflation would be the principal risk for 2021, and we have been right in that. Inflation has been the principal risk, and we said a year ago, start to hedge with inflation trades, buy gold, buy commodities, buy energy, buy sectors in the U.S. that are inflation plays, and they have done phenomenally well. The question now, Caroline, is where to from here? And I think we still have upside with regard to inflation and equity prices. The risk in the back end of next year, I think, is that the Fed comes to a realization, the Fed or markets, either one is bad news. The Fed comes to a realization that they have to jack up interest rates, and we could be seeing interest rate hikes faster and in bigger magnitude than what is currently priced into the market. Or alternatively, inflation remains persistent, driven, Caroline, by the labor market, which the Fed has very clearly said is not the principal driver, but perhaps they're mistaken in that, right? And the market says, you know what? We don't think that you guys can do this job now. So a loss of confidence by the markets and the Fed's omnipotence or infallibility, I would even put it, with this, complacence in the markets with regard to the Fed's ability to do it all, I think is an inherent risk. And I'm telling our clients to protect against that. Buy gold, buy cryptos, buy alternatives, buy real assets, buy land, buy real estate, things that you can protect yourself against the potential for stagflation, which I think is a real risk next year.
I didn't hear bonds in that list that you just mentioned. What's the role of that in the portfolio then?
Yeah, bonds probably are not going to be the best bet, right? I mean, if you're expecting inflation to go higher and the Fed is going to either be behind the curve or have to increase rates, fixed income is not our major overweight. If you're a dedicated fixed income investor, though, Taylor, we recommend shorter duration, floaters, some specific timely names in the quasi-sovereign space in emerging markets. There's still some bang for your buck you can get there. But certainly if you're expecting, or you think the risk is high of a stagflationary scenario, you don't really want to be there. I think what we're talking about here is finding places to make money in an inflationary environment with rates rising, and that's banks, that's industrials, that's materials, that's energy, even green energy, which has done remarkably well since we've recommended it. But look, you want to protect against the downside, and that's where you have some cash, raise some cash, get some gold, get some of those really defensive asset classes that can help you weather the storm.
Assuming we do get some sort of rate normalization here, Kathryn, and I know that, the Fed seems to kind of wave us away from that for now as it tries to sort of start this taper. But let's say we get to 2022 and we finally start to see rates come off the floor here. Is there sort of a time period or that you anticipate that it will take in order to sort of reach whatever that sustainable rate is going to be? And how should investors prepare for that?
The sustainable rate in terms of the Fed funds, I assume, is what you're saying.
Yeah.
And yeah, it depends, of course, on where we are in the inflationary environment. If in fact the Fed is wrong in that there is a wage price spiral, and anecdotally, anyone can pull out an anecdote about how there's so many jobs available, their wages are rising, employment, you can't find people to fill the job. So I think one of the real risks here is that there's a more persistent demand-driven component to inflation that the Fed is underappreciating. And if that's the case, Romaine, then I do think that we could see rates move towards the 3%, 3.5% rate. We're at 0 now, quicker and faster than what is appreciated by the markets today.
Kathryn, just lastly, you said you're hedging out some of the inflation risk. You got that call right. Anything else you're doing with your portfolio at the moment?
Yeah, right now, because risk is on and the Fed is basically giving a pass to inflation rates for the next 6 to 8 months, there are opportunities in the emerging market space. There's really not much yield to be had in the fixed income world, but there are in quasi-sovs. In Brazil, for example, even in Mexico, you can find some attractively priced fixed income instruments. You can also look at equities, such as in China. We still see some upside in the A shares. So within this space right now, I think you can put on some risk assets or put some money to work in those risk assets while protecting your portfolio with the accumulation of alternatives, commodities, gold, real estate, kind of broadening yourself out for what could potentially be a rocky, tumultuous road over the next year and a half.
Kathryn Rooney Vera, always love having you. Thank you. Head of Global Macro and Chief Investment Strategist for Baltic Capital Markets. Stay well.